see our basic earnings per share. That's all we're focusing on here. One more thing to add, we don't just take net income and divide by number of shares. Net income minus preferred dividends divided by, it's not just the number of shares that were outstanding. We've always been given that number, but what we're going to do in the remainder of this video is look at how do we come up with this weighted average number of shares outstanding. It's not just the number of shares that the company had on December 31st. What do? We take a weighted average, similar to how you would use a weighted average to calculate, let's say, your grade in a course, any other weighted average. We have to think of how many shares did we have at each point in the year, and for what portion of that year, or what fraction of the period was that number of shares outstanding. Let's take a look at an example. Frank's Inc. has the following changes in its common stock during the period. The company started the year with 90,000 shares outstanding, and then a few months later, April 1st, the company issued 30,000 additional shares. So between April 1st and then the next event date, July 1st, the company had 120,000 shares. On July 1st, the company purchased 39 shares as treasury stock, which reduced the number of shares outstanding. So from July 1st to the next event date on November 1st, there were 81,000 shares outstanding. On November 1st, the company issued 60,000 shares for cash, and so from November 1st to the December 31st, there were 141,000 shares. So we see how the number changes throughout the year. Let's calculate the weighted average number of shares outstanding. Every time we have one of these problems, let's set it up in a format similar to this one. Let's write out what are the dates that the number was outstanding. So for example, from January 1st, from one event date to the next, from January 1st to April 1st, there were 90,000 shares outstanding. What fraction of the year we're talking about here in our dates outstanding, January, February, and March, this is 3/12 of the year. So if we multiply the number of shares outstanding times a fraction of the year, we're going to get our weighted shares for each period, and then we're going to add them up to get the total weighted average shares outstanding. So 90,000 shares for 3/12 of the year works out to be weighted shares of 22,500. What's the next thing that happens? The company issues an additional 30,000 shares. So the company now has 120,000 shares outstanding from April 1st until the next event date, which is July 1st. 120,000 shares, you can ignore this. This is just how the 90,000 went to the 120,000. They were outstanding April, May, and June, so another 3/12 of the year, which works out to be 30,000. The next thing that happens is that the company purchases 39,000 shares on July 1st. So we reduce the amount of shares outstanding to 81,000, and that's between July 1st and November 1st. So what we did was we subtracted out 39,000. So we added 30,000 here. 120 minus the 39,000, we have 81,000 shares outstanding for July, August, September, and October, 4/12. And that works out to be 27,000. On November 1st, the company issued 60,000 shares for cash. So we have now an additional 60,000. So from November 1st until year end, at which time we're putting together the financials and reporting our earnings per share calculation, we have 141,000 shares outstanding for 2 out of the 12 months, November 1st through December 31st. And that works out to be 23,500. We add all of this up to get total weighted average shares outstanding. Equal to 103,000. And that's going to be our denominator in our basic earnings per share calculation. Now, what happens? We looked at when companies issue unissued shares and when they buy back their stock and then reissue. What happens when the companies have stock dividends and stock splits? When stock dividends or stock splits occur, companies need to restate the shares outstanding before the stock dividend or split in order to calculate the weighted average number of shares. They restate the issuance of a dividend or split, but not the issuance of a repurchase or an issuance of stock. Let's take a look at another example. Sabrina Company had the following changes in its common stock account during the period. January 1st, the company starts off with 100,000 shares. March 1st, they issued 20,000 shares for cash. June 1st, the company has a 50% stock dividend. Where did these 60,000 additional shares come from? Well, on June 1st, they had 120,000 shares outstanding. We multiply that by the 50% stock dividend. This is the amount of additional shares given, 50% of the existing number. We add an additional 60,000. Now that the company, remember when we have the stock dividend, the company is no better off because each existing stockholder got half of a share more than what they had previously. So the company is no better off. So don't we need to make this beginning 100,000? Don't we need to adjust that for the split the same way we did the 120? Don't we need to adjust this additional 20,000 the same way that we just adjusted this 120,000? So you take this information and use it to update our same schedule that we had before. So we start on January 1st and we continue until the event date. The next event date was on March 1st. The company had 100,000 shares outstanding. So we continue just as we normally would. Hold off on the restatement because on March 1st, we still don't know anything about the restatement. And let's just work in the fraction of the year, January and February. So this is 2 out of 12 months. And we're not going to multiply anything yet at this point. We'll prepare the schedule at year end, at which point we'll know whether or not we need to go back and restate. So let's leave the restatement field and the calculation for weighted shares blank for now. From March 1st until the next event date, which is June 1st, the company issued an additional 20,000 shares. So the company issued 20,000 additional. So the company had 120,000 shares outstanding. Hold off on the restatement. We're looking at what fraction of the year, March, April, and May, 3 out of 12 months. On June 1st, the company issues a 50% stock dividend. So from June 1st to November 1st, that's the next event date. The next thing that happens is on November 1st. The company has what? They do a stock dividend and give every shareholder an additional half of a share. So let's multiply our number of shares outstanding by 1.5 because all of the 120,000 are still outstanding, plus an additional half of that, additional 60,000. That's going to give us total shares outstanding of 180,000. And they're outstanding from June, July, August, September, and October, so 5 out of the 12 months. Now that we know that we multiplied these shares by 1.5, we're going to do the same thing here. We're going to adjust for this restatement. And we're going to do the same thing to those initial 100,000 shares. We don't need to do it here. So there's nothing to do here other than continue on to then multiply by the fraction of the year. Take the 180,000 times 5/12. We get 75,000. From March 1st through June 1st, we have a total weighted average shares of 45,000, and here we have 25,000. But there's one more event. On November 1st, the company issues an additional 30,000 shares. So from November 1st through December 31st, the company has 210,000. Add in 30,000 more shares. So the company has 210,000 shares outstanding. There's no restatement here. These are post-split or post-stock dividend shares. And this is outstanding for November and December 2 out of 12 as my fraction of the year. This works out to be 35,000. Then I'm going to add all these numbers up to get my total weighted average shares. Common shares outstanding equal to 180,000. And this would be my denominator in the earnings per share calculation. That concludes this video of weighted average shares outstanding for basic earnings per share calculations and our introduction to accounting for stock option compensation.